What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we're looking at how people, investors, traders look at their due diligence for stocks that they want to invest in. And boy, do we have a good one that we can use as an example today, UnitedHealth Group. So we're going to break down this idea as to why UnitedHealth Group is pumping after hours, and also the idea behind how we can look at this company as a due diligence example when we go into investing. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. So as you can see at the time of recording this, UnitedHealth Group is up over 10% after hours. Why is that the case? Well, Warren Buffett and Berkshire Hathaway just disclosed that they have bought 5 million shares of UnitedHealth Group worth about like $1.6 billion. And we all know Warren Buffett is that guy who is the one who is a value investor. He looks at those undervalued companies and he buys into them. And this was a huge announcement, which is why it is up about 10% after hours. Why? Well, psychology, the retail investors are going to follow up with these bigger investors like Warren Buffett, for example. A lot of people follow Nancy Pelosi. Some people follow Kathy Wood because they have all this money and they are seeing things. They have all this research available to them. And so people are looking at Warren Buffett as the one who has been the master and the end-all be-all legendary investor, and they put in 5 million shares with $1.6 billion. Well, what does that mean? Again, he sees something as a undervalue for UnitedHealth Group. And it's very interesting to think about what's going to be happening. And we'll take a look at some of the financials, give you guys a little bit more of an idea as to how due diligence works. Someone on After Hours asks us, Fridge, how does due diligence work? What do people look at for due diligence? Is it technicals? Is it financials? What is it? And we're going to talk about UnitedHealth Group because we can look at it from a technical standpoint, a chart, and also look at it from the financial statement. And now we also have this verification that Warren Buffett sees it as a good potential position to get into. This is his 18th biggest position behind Amazon and Constellation Brands. Their portfolio is worth $300 billion, which is absolutely amazing. And again, as you can see, it's also up again, 10% after hours. Now, the shares of UnitedHealth Group were down about 50% through Thursday's close before Buffett's filing that got released. The largest private health insurer has become the face of a public blowback in this country against the rising cost of healthcare. We all know we had that assassination that happened like months ago. The DOJ is looking into them as well for possible fraud and stuff like that. So very, very, almost like an unethical, people look at it as like an unethical kind of stock right now at the time of doing this. But UnitedHealth Group is a company that is one of the biggest insurers in the country. They are worth so much, and a lot of people have UnitedHealth Group. UnitedHealth Group attracted other buyers last quarter, according to Michael Burry and Appaloosa Management's David Tepper. So people are looking at it. And again, we'll talk about the idea behind it as we go into the financials here. So in taking a look at the financials first, we'll look at the technical side of things. Again, part of the due diligence is to look at the financials, understand the company, and know how it works. Now, this is insurance. It's the financial, it's finance, it's the insurance companies, right? We all know how insurance works. We all pay for insurance premiums, or we all pay for insurance so that way if anything does happen to us, we get some sort of coverage. I know people have been really upset about UnitedHealth Group for raising the prices, how much you pay for insurance, and and what they cover versus don't cover. It's a whole different situation to talk about. But from understanding a business perspective, again, people pay insurance, pay out of pocket, and then if anything happens, they get to hopefully have it not cost nearly as much. It's how the insurance game works for car insurance, for homeowners insurance, for health insurance, dental, all that kind of stuff. Very similar idea. So the company itself is pretty straightforward to understand in terms of what they do. I mean, they're an insurance company. I mean, we all know how insurance works. And again, people need insurance. Otherwise, these bills are ridiculous. So it makes sense that, insurance companies do relatively well overall as a result of this. Their PE ratio is very, very low compared to others. We'll look at the comparisons a little bit later on. Their PE ratio is only 11.67. Undervalued is usually anything under 20, and it's trading at an 11.6 PE ratio, saying that's very, very undervalued. It also pays a dividend yield as well of 3.25%, which is actually a really good dividend to look at here. And also, if we zoom in a little bit so everybody can get a little bit better visual, the debt to equity, again, which means how much debt they have versus how much equity they have. You want to be under 100%, otherwise they'd be bleeding out money. Their debt to equity is 75%. The fact that it's still under 100% with the recent sell-off of, however much percent it's been, from 621 down to 300 or down to 200 and something. Despite this sell-off, their debt to equity is still very, very good for this huge sell-off, right? So pretty impressed with that. We take a look through more. Again, looking through all their financials and how they're growing, their dividend payout ratio, how much they pay out quarterly. They actually also grow the dividend, which is really, really good for dividend investors who love to have that increase in their passive income every single year. So they've been growing their dividend on an average of 13% over the last 5 years. A lot of analysts are expecting to buy. They all have it rated as a buy, and the average 12-month price target right now is $327, a 20% upside. So some really good things on the surface here, but we can take a look at some more things as we look at. I like to look at the ratios because this actually summarizes a lot of things because it compares it to the industry. We want to see how it does to the industry. How does it compare to other ones? We don't want to compare it to NVIDIA because that's two totally different sectors. You want to compare it to Tesla, AMD, all those ones. You don't want to compare it to these over here. These are not insurance-related companies. You want to compare it to the other insurances in the sector. That's how you know how this company is doing. It is currently having, again, that 11.6 PE ratio, which is under the industry average. Very, very nice thing to see there. As we keep going down here, again, their margins are a little bit lower here, but their 5-year margins are a little bit lower here, and their operating margins are a little bit higher compared to other insurance ones here. So not super amazing, but the net profit margins are also very, very much better than the industry averages. So that's a very, very good thing to see as well. Again, profit margins is how much they're making after everything. So having that be higher than an industry average means they're doing relatively well. We can look at their earnings per share, and then diluted earnings per share. They're doing a lot better than the companies in the same industry. What else do we have here? Cash per share, cash flow per share. Again, just knocking out of the park. The revenue per share is unbelievable. 461 compared to 72.36 from the industry average, about 7 times more than the average here. So these numbers are knocking it out of the park here. Return on equity, a lot higher, which is good. Return on equity for the last 12 months, I should say, a lot better than the industry average. Return on equity over the 5-year for a 5-year average, also a lot better than the industry average. Return on assets is higher for both the 12-month and the 5-year. Return on investments also knocking out the park here. So seeing how good they are at managing this company is a very good thing to see from a financial perspective. Now, earnings per share from the most recent quarter to the quarter 1 year ago, this one is obviously down. They've had a rough quarter. Their earnings missed as well, I believe, last quarter. So you get a little bit of that kind of, that's a negative percent change because it was down from last quarter, obviously. But in taking a look at their earnings per share from the 12 months before to versus the trailing 12 months 1 year ago, basically looking at 1 year difference here, their earnings per share has grown 52% compared to the industry of 12. So again, very, very nice. 5-year earnings per share growth on the average, 1.6 compared to 1.39, which is obviously better. Their sales are obviously better than the industry averages here, which is really good to see. So some really good numbers to take a look at. Again, their debt to equity is actually still somewhat lower, which is interesting for the long-term debt equity. And the total debt equity, same thing. The debt to equity ratios are still lower than the industry average, despite them having this big sell-off, right? Because there's less equity in the company when you have a big sell-off like this, and the fact they still have a lower debt to equity compared to the industries is very, very good. See if there's anything else here to really take a look at here. Inventory turnover, net income per employee, yeah. Dividends, obviously they're doing better with dividends. Their average growth is better. Annualized dividend growth rate is basically in line with the industry average here. And the payout ratio is actually relatively lower. Payout ratio basically means how much of their cash are they actually paying out the dividends, which means that if it's a lower percentage, they have a lot more room to grow their dividend, which in this case they do. They pay out 36% of the amount of money they have. They pay out 36% of it to shareholders, which means you have all that upside to reinvest, put into research and development, put in all these different things to keep growing UnitedHealthcare as a company. So when taking a look at these numbers here, even with their recent sell-off, and again, it's not just a sell-off of 5%. It is going from $621 all the way down to 234 was the lowest. Right now it's at like 300 now. So we'll go to 300 just because, that's what it's trading at after hours right now. You're looking at, again, over a 50% decline in less than a year. A 50% decline in this company, and those numbers are still outperforming the expectations of other companies within the industry of insurance. Amazing stuff. Taking a look at it from a financial or from a technical analysis perspective here, you can see on the daily that it follows these fib levels pretty nicely. Again, rejecting off that 61.8 or bouncing off that 61.8% region, coming into that region, breaks out, and then again they had the huge news come out, just dropped the whole stock price, and it retested 325, but then it came back down to a low of 234. Taking a look at the 4-hour chart here, you can take a look and see that, there's that retest that you got at 325. And again, what we look for these kind of long-term plays here is looking for that nice momentum swing back up to the upside. And now with Berkshire Hathaway putting so much money into it, it's going to have a lot of momentum. Next stop, 325. If it breaks 325, next stop is 380 into the golden zone. And then after that, you're looking at 427. So minimum upside you're looking at right now at the time of recording this video, 285 up to 325 is about a 15% upside move, 14.5%. Higher than that, you're looking at now up to a 34% upside. And then into that golden ratio of 427, you're looking at a 50% return on your investment. And again, now there's momentum with the stock now because of the Warren Buffett, Berkshire Hathaway, announcement after hours today. And again, you take a look and kind of see that it kind of traded sideways along this little region right here between 473 and 538, comes back into that 61.8 level, and then it rallied up, and then it just had that bad news report came out, the DOJ investing into it, all that stuff. It was just the stars aligned for UnitedHealth in the worst way possible, and then boom, just sold right off, and now is where we're at as a result. We take a look again, going into the 1 hour and see if there's anything else that's really interesting to note here. Let's take a look and see the charts really quick, kind of see if we see anything. Again, here's that rejection multiple times here, so it does happen here as well. So it's happened multiple times. And see if there's anything else here. There's the nice little support level. There's the nice little support level down here in that 61.8% region. Another support level here. So again, these fib levels look pretty good to me overall. I'm actually pretty content with these fib levels, and I think they're going to do really, really well for UnitedHealthcare long term here. So this is kind of your idea behind how due diligence really works. And UnitedHealthcare is the best company to look at right now because not only are their financials amazing still compared to the industry, not only does the chart look pretty good look poised for a rebound here, but then you also have major institutions and investors supporting and buying into this company, which means that they see something as well as a value play, and that also kind of backs up that thesis. So putting all these things together creates a very good potential return for UnitedHealthcare. This is the summary of due diligence. And again, the more you understand the company, the more you know how the chart looks, the more you can use it to your advantage to make some really good profits. So that is it for today's video. Again, thank you guys so much for watching. I hope people on After Hours this answers your question about how due diligence works and the way to look at things as we move forward here. If you made this far in the video, make sure that you like the video, subscribe to the channel, turn on the notifications as always for all future uploads. Hope you're making money in the market. We'll see how UnitedHealthcare does long term. And as always, I will see you in the next video.